Markets are down over 2% yet again today. We have seen a lot of market volatility today as we struggle to stay above 3,000 and the 300 equivalent on the SPY. The news today was that many states are reconsidering opening the economy again, and many are considering putting the state on lockdown yet again, which could halt economic activity for the time to come, and as a result, the markets are once again spooked. If we look at what's holding us back today, we actually see a lot more diversified companies. A lot of tech companies are down today, as are the banks and the airlines, but they're not the only ones that are down. A lot of huge names are down today, which has caused us to go quite a bit lower. The question is if we can make a recovery at this point, and as much as I say it's likely due to what we've seen in the past, I don't really feel comfortable holding into the weekend given that the fundamentals now are being questioned. We can see that the uptrend here is arguably broken, in fact, as we struggle to stay above 3,000. I think the fact that it didn't break 3,000 is very bullish news, and this could go higher still, but depending on how you draw the uptrend, it may or may not be broken. I think if we close below the previous low here, right about the 301 level, it certainly would have been very bearish, but we managed to close above that level, which poses the probability that we bounce back above into the channel. But again, I don't think it's something I really want to bet on at the moment, given all the news we're seeing now about coronavirus. It's making its headlines back into mainstream media again. And remember, that thing brought us down all the way from here to here. That's 33%. It could cause our market to fall again. I don't think by nearly as much as this, since we've learned that a lot of companies are not really affected by coronavirus too much, and that we are much closer to a vaccine here than we were over here. However, I think that another wave of coronavirus can still very much bring us lower. If we do break out of this channel, I don't know if I'm quite interested in holding long positions. Truth be told, I actually sold off my positions at around 3 p.m. today. I just wasn't very excited holding into the weekend. I don't think the upside is really going to justify the amount of risk going into the weekend, especially because I was holding S&P calls. I sold those off. I wasn't holding weeklies. I was holding pretty long dated S&P calls, but still I was not very happy about the risk reward. So I decided to close the positions at quite a loss. I actually went in a few days before thinking that we'd see a bounce here as we did many times before, but it appears as though it may not be the case now, and so I wasn't too happy with the state of things, and I sold. But I don't think I'd be interested in buying puts quite at the moment. I'd have to see the markets fall below this level, I'd say, for a very confirmed structural break that this is now heading a lot lower. But I was talking about this area over here, about the 312 level. This is actually a very important Fibonacci retracement level as well. If we look at the long term, we weren't able to break through this level over here, the 78.6 level on the long-term Fib retracement. And I was really hoping for a break above it. I was hoping for yesterday's candle to be a reversal, but I think we now are breaking below the uptrend. If we look at the short-term Fib retracement from here to here, we are now testing the previous lows. I think that there are going to be many areas of support below this level again. If we look at it over here, there do appear to be a lot of noise here, and so if we fall, we can probably bounce off the top of this area, the 29.3, which corresponds to the long-term Fib retracement level of approximately 618. So 618 is going to be a very important level. Below that, the 0.5 level and the area right below the 0.5 level does offer another level of support. But if we break below there somehow, if coronavirus news brings us all the way down here and lower below the 23.6 Fib retracement level, we might just see March lows yet again, but I think that's extremely unlikely. If we do see anything close, in fact, to the 280 level, this would be a buying opportunity, in my opinion, but not an option buying opportunity unless you plan to hold long-dated derivatives, because, again, we've seen how this market is very, very trendy. If we fall, you don't really want to bet on a recovery until we've seen a very strong confirmation of a recovery. Looking into the other parts of the economy, we see that VIX once again is up. It's actually not up quite as much as I expected, to be honest. Yesterday we were much higher than where we were today at the close, and so I think it's hard to say at the moment. We're in quite a no man's land. I don't want to go short by any means because of how resilient this market is. If you short it at the wrong time, there's a possibility you won't see that level ever again. But at the same time, if you buy calls and we see a market crash, there's a chance that it won't recover, but your derivatives expire. And so at the moment, I'm looking towards individual stocks, and I'm also looking towards other markets. Gold is very much at highs at the moment. This might be the highest close we've seen in about 7 or 8 years. The gold market likes market weakness, but not a market crash, because if people decide to go into cash, they're going to sell off gold as well. I think this might be a good hedge against the stock market, but the overall market structure appears to be a bit overbought, especially as we near some important resistance levels at around the 1800 mark, but we might just test that level first. So in the short term, gold can probably go up another 2%. Oil today, I think, is interesting to look at. Oil is not nearly as bearish as I thought. We only fallen about 2.5% today, about the same as the S&P, on news that, again, the economy might not be reopening again and people might have to stay home. But oil is a very demand-driven market, so I'm surprised that it only fallen about 2.5% on news that shook the markets as hard as they did. But I think that if you want to hedge oil against the S&P, I think that might be a viable investment strategy, given that oil, in my opinion, is more sensitive to coronavirus and is relatively overvalued when you look at the S&P. That's pretty much where I see oil at the moment. We actually don't seem to be going much lower. I think oil is structurally different than where we were over here when it went negative, simply due to the fact that the supply isn't as much mismatched as it was previously, and we now have adequate storage to hold oil in the short term, so we don't see massive contango again. But again, I think that if the economy closes, we should see oil go much, much lower than where it is currently. If we look at the spread between the SPY and the QQQ, we're actually flat today, suggesting that the S&P might outperform the QQQ in the future, I think, given that we are down quite a bit in the short term and the long term. But there simply does not appear to be too many reasons as to why the S&P would outperform tech companies, even after what we've seen here. If we do see coronavirus lockdowns, again, tech companies are not going to be the ones that are heavily affected. And even if we don't see more coronavirus lockdowns, tech companies are fundamentally already in a much better position than are most other industries. So I think if you're going to buy stocks, QQQ and the tech stocks appear to be a stronger fundamental investment, but in terms of the valuation, I think a lot of this is overblown. Apple, as you can see, still at $1.5 trillion. If we see a lockdown again, that's not going to be good for the economy, not going to be good for earnings. I don't know if these valuations are justified, so just be careful if you do invest into the markets. Currently, I'm divested from the S&P. I'm now on the sidelines. I will go in if we see more areas to buy. And so with all that being said, I thank you very much for listening to my analysis on the S&P 500 index, and I wish you best of luck in your trading. Take care.